Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different subject from the world of investment and attempt to apply the principles of the craft as laid down by its founding father, tutor and mentor to superstar investor Warren Buffett no less. We're of course talking about Benjamin Graham. In today's episode, we should be taking a look at the art of stock selection. Specifically, we'll be taking a dive into the possible reasons why people in general are not particularly good at it. We will go on to see that a group of people who fit into this not very good category of investors include people whose very job it is to know what they're doing when it comes to stock selection. We will consider the role of luck when it comes to investment success, and finally come to consider what hope there is for the average investor who wishes to outperform the stock market in general. So without further ado, let's get right down to it. As ever, sit back, strap in, and get ready to absorb another lesson in value investment as inspired by Benjamin Graham. In general, everyday life, we expect people dedicated to a particular profession or another to be better at the task in which they specialise than the general population as a whole. If we were to undergo a medical operation of some kind, we would assume that the surgeon performing that particular task will do a better job than if the person holding that scalpel was a bricklayer or a hairdresser. Likewise, as handy as a surgeon might be with a scalpel, you'd be right to feel uneasy if you were to visit your local hair salon and found one of them perched behind your shoulder, ready to go to work on your locks. It is of course true that every profession has people operating in it that are just not particularly good at what they do. And I'm afraid to say that I don't think anywhere is that statement more true than in the world of investment professionals. Back in 2016, the Norwegian TV programme Ok Omi Ekspagna, or the Economic Experts, conducted a rather interesting experiment into this theory. And whilst the experiment was far from being scientific, I think that it did highlight a broader truth. That is, investment professionals in general are just not very good at what they do. In the show, the producers selected several groups of people who were each given 10,000 crowns, Norway's unit of currency, roughly equivalent to around 1,200 US dollars, to find out who would perform better in the task of selecting stocks over a 3-month period. Regular listeners will pick up right away why the investment horizon here straight away invalidates the potential outcomes. But we're certainly not going to let that fact get in the way of a good anecdote. The group was made up of a hodgepodge of trades and professions. To start with, we had 2 Norwegian stock market analysts. We also had an astrologer and a pair of beauty bloggers. But just to make things interesting, they included one final group of professionals here. That was a herd consisting of 5 cows. There is an obvious problem here, of course. How exactly to get these cows to make their stock picks? But the producers of the show were undeterred by this issue and came up with an ingenious solution. They split up a grass field into a 5x5 grid, and each of the 25 sections of the field allocated a business. When the cows did what cows so often do and deposited a stool of the type you don't want to sit on, then whichever unfortunate business this landed upon would be counted as an official pick. The producers obviously didn't want to be standing around all day waiting for cows to poop, so the cows were allowed 4 picks, and their investment would be spread equally between these 4 companies. The rest of the contestants were allowed to pick as many businesses to invest in as they liked from Norway's OBX stock index. The astrologer said she made her decisions into which stocks to invest based upon the fact that the year happened to be the year of the goat in the Chinese calendar. The beauty bloggers, meanwhile, admitted that they'd not heard of any of the businesses on the list, so their selections, they said, would be based upon which company names they liked the sound of best. The 2 analysts would, of course, draw upon all their training and experience in selecting the businesses they believed would perform best. After 3 months, the contestants were ranked in order of their performance over the period. In first place were, perhaps surprisingly, the beauty bloggers, notching up impressive gains of over 10%. Second place was a virtual tie between the stock market professionals and the pooping cows, with returns slightly in excess of 7%. The year of the goat proved not to be a great one for the astrologer, who came in last with a sub 5% return. All the contestants, however, did significantly worse than the producers of the show, who revealed that their selection had netted a return of some 24%. But the producers then went on to admit that all was not as it seemed. There was, as there so often is with these types of show, a twist in store. It turned out that they'd outperformed everybody else only by bloody cheating. They had in fact entered not one selection, but 20 separate portfolios, each containing a different mix of businesses. They then reported the performance of the one that did the best. They did this to highlight a little trick that some asset managers like to pull. They will start with multiple portfolio combinations, but then will quickly shut down the ones that fail to perform. They are then free to report only on the good results of those that have survived the cull. In January 2020, the Financial Times reported on this concept of survivor bias and claimed that by adjusting for closed or merged funds, a true indication of how the average fund performs emerges. They said that the S&P semi-annual scorecard does just this, and it reveals that just 1 in 8 US equity fund managers outperformed the broader stock market over the past decade. Quite an eye-opening statistic indeed. The pooping cow experiment was, of course, just a stunt, and there have been similar experiments carried out in the past, such as Orlando the stock-picking cat, but it does highlight a wider point. Many professional stock pickers suck at what they do, but given an infinite amount of stock pickers and an infinite amount of portfolios, someone somewhere is going to look like an investment genius. This is a similar charge that is sometimes thrown at Warren Buffett and other successful value investors. That is that they are simply just the survivors, the ones who have rose to the top of the performance charts through simple good luck alone. Buffett rebutted this claim using the analogy of a national coin flipping contest to prove why luck does not come into it when it comes to value investing. He posited that if 225 million orangutans were to take part in this coin flip, and they found that 215 of them managed 20 consecutive winning flips, that is, they managed to guess the flip correctly, then most people would regard the winning flippers as being simply lucky rather than having some innate skill or ability to call the correct flip. But what if, he said, out of the 225 million orangutans, who are roughly equally distributed across the United States, they found that the 215 winning orangutans happened to all come from the same zoo in Omaha, Nebraska. People would probably want to go to that zoo and ask the zookeeper what they were being fed, whether they're having the same special exercises, and perhaps what books they've been reading. This, of course, is an analogy to demonstrate the inordinate success of practitioners of the value investment approach. It is certainly not possible all our success, the Buffetts, the Grahams, the Klarmans and the Marks, is down to pure luck, but it is certainly a startling coincidence that we all happen to come from the same zoo, and we've all read the same books. I will let you come to your own conclusions on that one. To conclude, we can surely see that most people, whether they happen to be butchers, bakers or candlestick makers, just aren't very good at investing. This lack of any special ability to routinely do better than the markets in general also extends to many professionals operating in the industry. As far as I can tell, there seems to be only one group of seemingly super lucky individuals who time and time again produce market-beating performances. And it just so happens that this group all have one strange commonality. That is, they've read the complete works of a certain Benjamin Graham. On that note, I shall draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed it. If you have, you know what you can do. Please hit that Add to Playlist button, that way you need never miss a future edition. And do continue to spread the word, it really does make a huge difference. Thanks for listening, I'm David Coombs, this has been Intelligent Investment Today. Until next time, stay safe and happy investing.